Hi. In this mini lecture, we're going to be finishing up the mini lectures for Chapter 2 by covering Learning Outcome 2-4, which is preparing a trial balance and a classified balance sheet, and also Learning Outcome 2-5, interpreting the balance sheet using the current ratio. Take out your Chapter 2 Essentials document, and let's turn to the second page. The accounting cycle. Notice that daily business transactions occur and we analyze them, then we record or journalize them, and then we post or copy that information into our Ledger T accounts. But at the end of the month, before we prepare the financial statements, we prepare something called the trial balance. It's a listing of the ending balances in every T account, and then we add down to see if the total debits equal the total credits. If they equal, then we know that the financial statements will work out mathematically. It doesn't mean that there are no errors, but simply that the balance sheet will equal, and we'll talk about errors in just a moment. If the trial balance equals out, then you can go ahead and prepare your financial statements or reports. Now let's flip to the back page of that same document, the Chapter 2 Essentials document. This one's called How to Calculate the Balance of an Account and Prepare a Trial Balance. And here's our definition. A trial balance lists all accounts with their balances and shows whether the total debits equal the total credits. A trial balance is created after all transactions have been journalized and posted, and each account has been balanced at the end of a period. A trial balance is always prepared before the financial statements are prepared. So now let's first learn how to calculate the balance of an account. To do this, as we indicate, we add up the debits, add the credits, and then subtract. The difference, or the balance, is written on the side that is bigger or larger. Let me cover up the balance here and we'll show you what we mean. I have a plus on the debit side of the cash account because we increase assets by debiting. I have a minus on the credit side because we decrease assets by crediting. So let's follow our directions. Add the debits. 10,000 plus 5,000 equals 15,000. Now add the credits. 2,000 plus 3,000 equals 5,000. Now subtract. Total debits of 15,000 minus total credits of 5,000 gives us a $10,000 balance, and it says that the balance is written on the side that's bigger or larger. Well, there are more debits than credits, so it's a debit balance of 10,000. Let's try the same thing, but with a liability account. Accounts payable is a liability. We increase liabilities by crediting, so I put a plus sign here, and we decrease liabilities by debiting, so I put a minus sign on the debit side. Let's follow the same process. Add the debits. 2,000 plus 4,000 equals 6,000. Add the credits. 5,000 plus 6,000 equals 11,000. Now subtract. 11,000 minus 6,000 is 5,000, and that goes on the larger side, which is the credit side. So we have a credit balance of $5,000. We would do that for every one of our accounts. Now, you'll notice that the normal balance for any account is the same side that you would increase that account. So since we increase assets by debiting, you would expect assets to all have debit balances. We increase liabilities and equity by crediting, so we would expect those accounts to all have credit balances. That doesn't mean that they have to, because it is possible to have an abnormal balance. For example, if you overdraw your checking account by writing more checks, more credits than you have in deposit debits, you would have an abnormal credit balance. So it is possible, it's just not as likely. The normal balance is the side you would increase the account. Okay, so now let's take a look at our worksheet, and let's do the same for M2-11. Okay, so here's our worksheet, and here's M2-11. Now I'm going to write down the numbers that I have in each of these, the debits and credits, just so that we can see how we do this. As another example, let's add down the debits to cash. 3,940 plus 4,630 equals a total of 8,570. Remember, I would normally not put this number there, but I'm doing it for demonstration purposes. Now let's add the credits. 200 plus 300 is 500. Now we would subtract. 8,570 minus 500 is 8,070. Let's draw a line. And let's put that balance, 8,070, on the larger side. So we have a debit balance of 8,070. And I'm going to put BAL to indicate that it's a balance and not another debit. Now let's take a look at supplies. We add down the debits. 300 plus 700 is 1,000. And there are no credits to subtract, so this becomes a debit balance of 1,000. For our equipment account, we only have one amount, so that is its balance. Now let's look at notes payable. 3,940 plus 800 is 4,740. There are no debits to subtract, so we have a credit balance of 4,740. With accounts payable, we only have one amount, so that becomes its balance, $700. And the same thing for common stock. We only have one amount, so that becomes its balance, 4,630. Now when you do this process in Connect, you will be posting your dollar amounts to the left and right side of the bar that forms the T, and then you'll have to post the letters to the far left and far right as well. But you won't have to calculate the balances in Connect, because Connect will calculate those balances for you. Okay, let's go back to our Accounting Essentials document to learn the next step. Step 2. Okay, now the next step in preparing a trial balance is that each account in the ledger, each T account in other words, is listed along with its balance in either the debit or credit column, depending on the type of balance it has. The total of the accounts with debit balances must equal the total of the accounts with credit balances in order for the financial statements to be mathematically correct. So let's do that for Spotlighter Inc. So we're going to be using information from the T accounts above to prepare our trial balance. So we're going to be copying the account names and their balances. Cash, debit balance of 8,070. Let's see. We copy this into the debit position, 8,070. Now supplies, debit balance of 1,000. Now equipment, also a debit balance of 1,000. Notes payable, credit balance of 4,740. accounts payable, credit balance of 700. And finally, common stock credit balance of 4,630. Now we add down 8,070 plus 1,000 plus 1,000 equals 10,070. 4,740 plus 700 plus 4,630 equals 10,070. So our total debits equal our total credits, and we know that we can now prepare our financial statements because mathematically they should be correct. But what do we do if they don't equal? Well, let's go back to our Accounting Essentials document and see. Before we even take a look at 3 here, what to do if they don't equal, my advice would first be to just add down again. Add down your numbers again, because perhaps you just put them in the calculator incorrectly. Next, I would look at the columns. We know that the normal balance of an account is the side that you would increase that account on. So since assets are all increased on the debit side, you'd expect all assets to be in the debit column. And you'd expect liabilities and equities, those types of accounts, to have credit balances. Sometimes you can catch your error by noticing that you put something in the wrong column. If, when you add down, they still do not equal, I would trace these back to the T accounts to see if you copied the amounts correctly from the T accounts. And then finally, if you calculated the balance correctly. But let's take a look at a few hints that they give us in 3 here. It states that if the difference between the total debits and credits is evenly divisible by 9, that it could be a transposition, a reversal of numbers. For example, you may have posted a debit of 34 and a credit of 43. The difference there would be 9. Or you could have posted a debit of 340 and a credit of 430. That would be a difference of 90, both evenly divisible by 9. Or perhaps you committed a slide. You move the decimal point between the debit and credit to the left or the right. For example, writing 100, maybe a debit of 100 and a credit of 1,000, or vice versa. Again, the difference here would be evenly divisible by 9. If that's not the problem, then multiply the difference by 2 and divide the difference by 2 to see if one of those numbers actually appears in the debit or credit column, because it could be that you put the number in the wrong column. Then again, if you followed what I said earlier, by viewing the normal account balances, you should have caught that earlier. And finally, in C, if neither of those 2 things work, perhaps you just missed copying the balance of an account. Okay, so now let's prepare a classified balance sheet. To do this, I'm going to first go to the Chapter 2 notes. So this is what they look like, and they're also in the Please Print folder in Chapter 2 in Blackboard. Now what we just did is we prepared the trial balance, what we see here. Now we're going to be talking about a classified balance sheet. A classified balance sheet is simply a balance sheet with headings that will help our readers of our financial statements. In particular, we're going to be adding the headings current assets and current liabilities. Current assets are assets the business will use up or turn into cash within 12 months of the balance sheet date. So our current assets would be, well, first of all, cash is already cash. Supplies we will expect to use up within 1 year of the balance sheet date. Current liabilities are debts and other obligations that will be paid or fulfilled within 12 months of the balance sheet date. So, for example, accounts payable, which normally has a due date of 30 to 45 days, would definitely be paid within 12 months of the balance sheet date. Now, if you look at the accounts in each category handout that I gave you in this chapter or from chapter 1, we have our current assets listed here and our current liabilities listed here. Again, current assets are assets that are expected to be used up or turned into cash within 1 year of the balance sheet date, and current liabilities are expected to be fulfilled or paid within 1 year of the balance sheet date. Now, why are we bothering to do this? Why are we bothering to classify our assets and liabilities as current and non-current? Well, remember that the goal of financial accounting is to provide useful information to the readers of the financial statements. By separating out our assets and liabilities into these two categories, we can help them analyze whether the company is able to pay its current liabilities using its current assets. And there's a calculation that we can use called the current ratio. We'll look at that, and then we will prepare a classified balance sheet. So we're now in Learning Outcome 2-5, interpreting the balance sheet using the current ratio. Okay, so here is our current ratio. We take our total current assets in dollars and divide by our current liabilities. This tells us whether there are sufficient assets, current assets, to pay current liabilities, and the higher the ratio, the better the ability to pay. Current ratios typically vary from 1.0 to 2.0. So let's prepare that classified balance sheet for Spotlighter Inc. And then we'll calculate a current ratio as well. Okay, we left off with our trial balance. Now we can bring information from the trial balance onto the balance sheet. So I'm going to put one directly below the other. Hopefully we can see both. There we go, pretty close. Now before we get started, let me briefly tell you that the format that you're looking at in this balance sheet is called the account format. In Chapter 1, we prepared balance sheets where the liabilities and stockholders' equity appeared directly below the assets. That's called the report format. When we put liabilities and stockholders' equity to the right of the assets, this is called the account format. So what we're going to do here is choose which of the accounts are current assets. That would be cash for $8,070. Supplies for $1,000. And that would be it, because equipment lasts longer than a year. So let's subtotal on the current assets and we'll get $9,070. Equipment is a non-current asset. Actually, it's called a long-lived tangible asset, and we'll learn about those in later chapters. That was $1,000. Now when we add down, $9,070 plus $1,000 is $10,070 in total assets. Now our current liabilities, which have to be paid off within a year or less. Well, if you recall from our journal entries and our description of our transactions, both of the notes were due within 1 year or less. They're both considered short term, so they're going to be current liabilities. You might not be able to fit short term in there, but I'm going to try. And that's $4,070 $740, and then we have accounts payable, which also has to be paid off within a year. And that's $700. And common stock is an equity account, so let's just add up those two liabilities. They total $5,440. Now our common stock is $4,630. And we have no retained earnings, so we'll just put retained earnings 0. We'll total our two equity accounts. That totals $4,630, and now add together our liabilities and stockholders' equity. $5,440 plus $4,630 equals $10,070. And our assets do equal our liabilities plus our stockholders' equity. Now let's try that current ratio to see if we're able to pay current liabilities using our current assets. And we can see that right now we can do that dollar-wise. Our current assets are $9,070. Our current liabilities, which happen to be our total liabilities, are $5,440. So we can very much pay our current liabilities using our current assets. I'm going to abbreviate current assets as CA and current liabilities as CL. Let's just do a little calculation. Current assets are $9,070. Current liabilities are $5,440. Let's divide, and we get 1.66727. If we're asked to round to one decimal place, we look to the right of that place. If it's 5 or above, we increase the first decimal place to 7 in this case. 1.7 would be our rounded current ratio. So we have 1.7 times more current assets than current liabilities. And we are done now with Chapter 2. If you have not yet begun your Chapter 2 homework problems, now is a good time to get started because it will take you some time to get it done. Have a great day.